Welcome to TradeTheNBI.com. This is John. This report is for the first, and well, we expected more fireworks, and we got them. I don't know if it's better to say the Fed agreed with me, or we were in line with where the Fed was thinking, because the numbers just didn't suggest that there was going to be any kind of rate cut or even one coming in the near future, given what we're seeing. And we expected that that would give us, a fill back into, the positive extremes, which obviously we've now filled in the secondary one of the initial breakout, taking us all the way exactly to the ABM green. We were looking for a move that might take us as much as to the 76%, but that is still rising. So we're literally going to de facto get to at 65, and the low is 66. So one half day, discrepancy between its connection and that, but still, nothing was surprising about this. The Fed can't really do a whole lot on rates or anything like that, given where oil and that is, and this was pretty clean. I don't think there was anything discrepancy wise. What was interesting is they're back off on the strength of banks, from being well positioned to maybe a little bit more difficult in this part of the liquidity that they had to inject, which caused a lot of this up rally that other people were thinking was related to other things, but it was the reality that there were some banking issues and they had to supply excess liquidity, and that excess liquidity is always a bonus for the market. The reality of NQ in that, much softer. I mean, you saw the difficulties that Apple's having and some of the broader economic concerns that are growing, which we knew would start to take effect about this time. When we talked about this, last September, as rates in that were elevating, that we would get to this threshold at the first quarter here, where it starts to bite. And that's having that exact impact. And so you're finally seeing it. Created DOC spread, nothing too dramatic, because when you're doing DOC spread that's all the way this elevated, yeah, we're going to see a little bit of drawdown, but it's already leveling out. And we didn't get the steel dip below negative 13.5. So short-term buyers are completely reset, and we're into rising gold here, as you see on the shakeout. So for now, I think more muted, but nonetheless, it was fairly easy to see that the Nasdaq had been leading things, and when it broke below that 33 level, that was the beginning, and now below 25, definitely exposed to far more selling and weakness within the given construct. Treasuries again yield again outside of the range of where the Fed is talking, because now they all think that, well, then the Fed is going to move to June, July cuts, or towards the election, and this is that speculation game. But also, you get a lot of money flying in when market starts to fade. Of course, I wouldn't even call that much of a fade, given the percentage where we're at. It was some modest move at best. But oil cleaning above that 75 again. I think that literally, and even above 70, it's still, from a Fed standpoint, you're not going to get to their 2% target, which is nonsense, because we all know that inflation is running much higher than that. It's irrelevant, and they can see it too. They're not complete idiots. They get the data as well. They just have to make things sound nice. So that's problematic from a rate standpoint until you cut that down into the lower 60s or 50s. You know, and it's a balancing act, because by doing that, you would spur enough growth that you would stave off any problems with where rates are at. It continues, and you will get a slowdown, but it's not going to help with inflation, and that becomes the stagflation conundrum. So that's the concern that they're battling with. And if you cut rates too quickly, and then you get this arbitrary inflation of the equity markets, unrelated to the real world. And so, as we talked about, as oil goes and the euro zone unable to match what the U.S. is doing, we're going to move back down. In fact, it's still way elevated for where it should be. And should be as a relative term too, because at the end of the day, there are people buying euros at that value versus dollars. So there you have it. Gold, initial pop, but I didn't think that was going to do much of anything. Again, it's going to be a catalyst for world events. And of course, you see world events spiking. Everyone in Europe's talking about war with Russia. The U.S. is now sending nuclear weapons to England for the first time in 15 years. Just a lot of things that are escalating situations that can get ugly and just create more global issues. And the global issues are unlikely to be directly to the superpowers. They're always going to be through third parties. So whether it's Yemen, whether it's Syria, and some of these other things, there's just going to be added conflict, which adds to risk when it comes to trade. It's just that simple. Um, so just continue to follow our readings. I mean, obviously, we could see where the economy economically was going. Bitcoin and them suffering a little bit because they want easing, because easing means devaluation. Devaluation supports the idea of being outside of the dollar from its valuation situation. And you can see that's a strong spike of MBI white to the peak there. So we could see some continued sell off in that range. Not as bad from a ETH, still relatively behind Bitcoin in that, but nonetheless, again, the top two cryptos, they're still holding on and doing just fine. It was pretty straightforward from the sell that took place. The short began and very successful. White MBI lead led to a 0% move. Spiked up a little bit on solid MBI white. The minute that pivoted down, boom, we were right back to the zero again, and that followed through. So that just doesn't get any easier than that configuration. When we look at it right now at the 50K, pretty extreme from a shakeout readings. And so that's going to have to build back. So 23% right here will be critical. Buy above, stay short below. 87.50 is where that is. So that makes it pretty clean. Intraday, when we were looking at it, started with the selling kind of based, and then as the Fed talks, we got excited and brought back up to the highs of the morning pre-market, only to watch it dump off when they didn't get to hear that they're going to get more of that liquidity. And they talk about the Fed being hawkish. I think they were just being pragmatic. Wouldn't even describe it as anything other than that. So everyone can have their debate about what the Fed is in their role, but all we can do is go with what is and follow what the readings give us, and we could see where we're headed with that, and we could see some misalignments in the market, whether it's treasuries and or the relationship of the market to where economic growth is. So there are definitely more concerns, but we talked about that climate of fear that is typical in bullish trends. And I don't think you've dissuaded the market that they believe the Fed will have to cut and be forced to capitulate to them. So again, it's a game of chicken at this particular stage. So as always, we'll just continue to follow the readings, and anything relevant, I'll put it on the Skype chat. Have a good one.